On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone's well. Let's run through all of the key developments that we saw last week, then let's turn our attention to what's coming up in the week ahead. Global share markets, a very good week for most. The S&P 500 index in the US was up 1.6%, UK shares, European shares up almost 1% each, Japan up 1.8%, emerging market equities even stronger again. They were up 3.9% last week, and that takes the year-to-date gain from emerging markets to 23.3%, a fantastic return. Closer to home, the Australian ASX 200 and the local NZX 50 index, they pretty much went sideways. They were flat for the week. Interest rates in the US continued to drift lower. The US 10-year Treasury yield finished the week close to a 5-month low of 4.1% or just below that. And here in New Zealand, the 5-year swap rate slipped 5 basis points, finished the week at 3.28%, and it hit the lowest levels we've seen since March 2022. So the NZX Corporate Bond Index, which is a good proxy for the fixed income portfolios of private investors, the NZX Corporate Bond Index is up 4.5% so far in 2025, which is a very decent return for a conservative asset class, and it's actually outpaced the local share market and the local housing market quite easily. Right, looking back at some of the key releases, and there were two that I'll touch on. The big one was US inflation. This was the major release of the week, the US Consumer Price Index for August. It was in line with expectations on an annual basis, although we did see a slightly higher monthly print. The headline CPI was up 0.4% for the month. That was above forecasts for 0.3%, and it was the strongest since January this year. The core CPI up 0.3%. That was in line with forecasts, and it was the same as we saw in July. So on an annual basis, the headline CPI increased at a rate of 2.9%. That's the highest since January, and the core CPI unchanged at an annual rate of 3.1%. So there's definitely a bit of pressure coming through from tariffs. We saw that across several categories: clothing, auto parts, electronics, those sorts of things. But 2.9 for the headline, 3.1% for the core. Markets were pretty comfortable with that because at least there was no nasty surprise, at least not at an annual level. It came in as expected. So markets responded positively to that CPI report. We also had the ECB, the European Central Bank, and it left interest rates unchanged. That was as expected. Now, the ECB has cut its policy rate 8 times this cycle, so it started out at 4% last year, and that's the highest that we've seen since the euro currency came into being in the late 1990s, 4%. Today it's at 2%, so they've already gone from 4 to 2. They've got inflation down to 2.1%. That's where it's averaged over the past 6 months or so, very close to their target of 2%. And economic activity is looking a little bit more promising. So the ECB is probably at the end of its easing cycle. There might be one more cut from here. Markets see that as about a 50-50 likelihood, or they might be done. So I would say we've probably seen the end of the rate cuts from the ECB. If there is one more move, there'll only be one more, and it probably won't come until next year. So that was the European Central Bank. Looking ahead to this week, and it will be another big week of central bank meetings. We've got decisions due from the Federal Reserve in the US, the Bank of Canada too, also the Bank of Japan, also the Bank of England, and there might be a couple more as well. So it's a very, very big week. The highlight will be the Federal Reserve, and their decision is due out at 6 a.m. on Thursday morning here in New Zealand. The meeting takes place on Tuesday and Wednesday in the US, and it'll be out at 6 a.m. Thursday in New Zealand. That will be followed by a press conference with the chair, Jerome Powell, at 6:30 usually. Now, the upper bound of the Fed funds rate is sitting at 4.5%. It peaked at 5.5% in 2023 and 2024. That was actually the highest we'd seen since 2001, and the Fed cut it by 100 basis points over the second half of last year. And they've been on hold since then. So we haven't seen a rate cut from the Fed since December last year. That is expected to change this week, and we are expecting to see a 0.25% rate cut from the Fed. That's fully priced, and looking out to the middle of next year, financial markets see 118 basis points of easing, which essentially means almost 5 rate cuts, 0.25% rate cuts. So we'll be watching the forecast that we get in the SEP, the Summary of Economic Projections, and that will allow us to see how the Fed's view aligns with that of the market. So that will be the key event on Thursday morning, the Federal Reserve, and I'd expect that to be taken positively if you do see that cut, like markets are all expecting. We'll also see central bank meetings in the UK and Japan, among others. The Bank of England meets on Thursday evening. Little chance of any change there, so I would say that the policy rate will remain unchanged at 4%. That's still down from where it got to last year, got to 5.25, down to 4. No change likely coming this week. We might see further cuts from the Bank of England, although probably not until 2026, because we have seen a bit of upward pressure on inflation just lately, and the headline UK inflation rate actually hit 3.8% in July, which is the highest we've seen in about 18 months. So the BOE is probably on hold. That'll be Thursday night, and then on Friday we will get the Bank of Japan. So that's the trifecta of big central banks, the Fed, the Bank of England, Bank of Japan on Friday afternoon. No change expected from the BOJ. They're expected to move quite cautiously as they increase interest rates. Remember, they're on a different path to other central banks. The next move upwards is seen in either December or in January. So no change expected from the BOJ either. What else will there be? On the economic front, we'll get US retail sales for August. That will be on Tuesday evening. That'll be interesting because we have seen some soft labour market data, so it'll be good to get a read on where the consumer is at. While we're talking about labour market data, jobs data, it has been weak lately, but we've just got to remember that we've also seen much lower immigration in the US due to policy changes this year. And what that means is that the level of break-even employment growth, which is essentially the number of jobs that the US economy needs to add each month to keep unemployment unchanged, that break-even level is lower than we've seen in recent years because you haven't got all that immigration coming in, and those people don't need jobs created to give them jobs. So just bear that in mind. The lower non-farm payroll numbers that we're seeing aren't quite as bad as what some of the headlines might suggest initially, because that break-even level of employment growth is lower. We'll also get a dump of Chinese data this week on Monday afternoon, 2 p.m. I think it is New Zealand time, fixed asset investment, industrial production, retail sales. That will be interesting. And here in New Zealand, there is quite a bit going on. We should get the housing market report that I was expecting to get late last week. That should be out early this week. So last month's figures pretty sluggish across the property market. That was for July, but a few improving signs. So the August figures will be interesting, and that will allow us to get a sense of whether the market is responding positively now that we've seen mortgage rates come down a little bit more, and as we move into that traditionally more buoyant time of year for the New Zealand housing market. So I'm expecting that to be out on Monday morning, but I thought it'd be out last week, so I might be wrong again. We'll wait and see. We'll also get a dairy auction early on Wednesday morning. Now, a fortnight ago, the headline index fell 4.3%. That was its biggest fall in more than a year, and we saw whole milk powder fall, we saw skim milk powder down. The only positive mover was cheese. So markets were braced for that negative outcome, but it was weaker than expected. So we'll get an update on where the dairy sector is at on Wednesday morning. But the highlight for us will be the GDP report for the June 2025 quarter. This is out at 10:45 a.m. on Thursday, And after 2 quarters of expansion, the Reserve Bank and most economists are expecting the economy to have contracted by 0.3% in the June quarter. So that is disappointing. That is an ugly number, and that will make for some pretty disappointing headlines. However, we do need to remember that this will likely prove the low point this year, and that activity has got better since then. Remember, this is a June quarter, so April, May, and June. We're now in the middle of September, so it's kind of old news. So it'll be bad news, but it's sort of in the past. So we need to focus on some of those other indicators that we're seeing that are a bit more up to the minute, like the electronic card transactions from last week, not too bad. Like the ANZ truckometer, not too bad. Like some of those other indicators that we've seen. So this will be out on Thursday and it will get all the attention. I don't think it will move the dial for the Reserve Bank because it's in the past, but we'll see. Right now, market pricing implies that we will see another OCR cut in early October, and that there's a good chance we'll see one to follow in November. So there's a decent chance that the OCR will finish this year at 2.5%. Right now it's at 3%, might finish this year at 2.5%, which is where the Reserve Bank has said it will take it to. So if you get stronger data, maybe you'll only get one cut this year, and then you'll get the final one in early 2026. But at the moment, I think there's a very good chance that you get 2 further cuts, and we get to that 2.5% before Christmas, which I think would be fantastic for the economy. Right, beyond that, there isn't a whole lot else. There won't be much on the corporate front. We've got a couple of AGMs here in New Zealand, Contact Energy, Mercury in New Zealand, so we'll hear from those two businesses. Internationally, not a lot on the calendar, although FedEx is reporting a result on Thursday overnight, so that's always interesting. FedEx is quite closely linked to the economic cycle, so maybe we'll learn something from that result. Otherwise, enjoy your week. Have a good one, everybody. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.